No one in mainstream finance seems to be addressing what just happened overnight, yet the signal flashing in the silver market is impossible to ignore. Silver's volatility gauge just surged to 115. To understand how abnormal that is, remember that most of the time this index lives somewhere between 15 and 40. Once it moves above 100, we're officially in extreme territory. And here's the part that should really grab your attention. Volatility is now even higher than when silver pushed toward the $120 level just 3 weeks ago. In other words, the options market is bracing for bigger price swings now than it did at the previous peak. That's not random noise. That's the market preparing for turbulence. For those new here, I'm OG John AG. At this point, I don't spend time convincing anyone. Either you look at primary data yourself, or you choose headlines. Either you read settlement documents and filings, or you rely on commentary. Some people come for information, others just want arguments. The ones who verify facts don't need persuasion. The ones who don't usually disappear when markets get rough. Quick reminder, if you see accounts posting updates under my name but with a different handle, they're fake. Names can be copied easily. Handles can't. I don't sell courses, and I'm not here to spoon-feed anyone. The people who belong here are usually the ones already posting extra sources and corrections in the comments. If you're one of them, drop where you're watching from. That's how I know who's really paying attention. Now let's look at prices because the divergence is getting harder to ignore. Western Silver Spot trades near $73, futures roughly the same. Meanwhile in Shanghai, spot prices hover around $86 with futures even higher. That creates roughly a $13 premium between East and West markets. And it's holding despite heavy selling pressure in Western paper markets. Gold is showing similar distortion, with Western prices slipping below previous levels while physical premiums remain sticky overseas. Yet financial media is already declaring the metals bull market finished after a large correction from recent highs. But what happened yesterday across broader markets gives us a clearer explanation for why metals were slammed so violently. U.S. equity markets experienced massive two-way swings within hours. The S&P first dropped about 1%, erasing hundreds of billions in value, then reversed and gained even more shortly afterward. Nasdaq followed the same pattern, heavy selling followed by an equally aggressive rebound. Healthy markets don't behave like that. Moves like this are typically signs of forced liquidation. When leveraged funds face margin pressure, they don't sell based on fundamentals. They sell whatever they can liquidate fastest. Positions that are profitable or liquid get dumped simply to raise cash. At the same time, banks tap the Federal Reserve's repo facility for roughly $11 billion, including Treasury and mortgage-backed securities. That window hadn't been touched since early January during the last major silver squeeze event. Facilities like this usually remain quiet when markets are calm. They activate when liquidity pressure starts building under the surface. And that leads to the key point many investors miss. When stocks, metals, and tech all drop together, the market isn't debating value anymore. It's chasing cash. In normal risk environments, falling equities often send investors toward gold as a defensive move. But during liquidity stress, everything gets sold. Funds unload whatever they can to cover obligations. The dollar rises, and asset classes get hit simultaneously. What we're watching looks less like a simple correction and more like deleveraging. Large players were long across multiple asset classes using borrowed money. Once tech stocks started falling, they needed cash quickly. Metals, being highly liquid, became easy targets to sell. This pattern isn't new. Financial historian Charles Kindleberger documented how crises unfold through predictable stages: optimism, expansion, peak confidence, early profit-taking, and eventually panic when leverage begins unwinding. During panic phases, fundamentals temporarily stop matching because participants are scrambling for liquidity. Historically, metals often weaken before broader equity sell-offs because they get liquidated first. That doesn't mean the long-term thesis collapses. It means margin calls don't discriminate between strong assets and speculative ones. Now add current macro signals into the picture. The dollar index is strengthening. Volatility indices are rising. Treasury yields are falling as money moves into government bonds. That combination usually signals investors positioning defensively. A stronger dollar tightens global liquidity. Rising volatility means institutions are buying protection. Falling yields indicate money-seeking safety. Together, these signals often precede stress across equities, commodities, and credit markets. Tomorrow brings FOMC minutes, followed by several high-impact economic releases later in the week. For short-term traders, these events often create volatility windows where large players reposition while liquidity is available. The data matters, but how institutions use these moments matters even more. For traders asking about technical structure, this next section is real tape reading, not the simplified pattern explanations sold in trading courses. Screen time matters. Years of watching price behavior across assets build instincts that shortcuts can't replace. I've spent nearly 2 decades studying charts across futures, forex, equities, and crypto markets. I've lost money learning lessons most people try to skip. That experience transfers across markets because price behavior follows recurring human psychology. If you want deeper analysis, do your homework first. Mark your charts. Post your work. Show that you're applying concepts instead of just consuming content. Then we go deeper, but only for people serious about learning. Now open a daily silver chart. Mark the low from December 31st, 2025. Then look at the move on February 6th, when price briefly broke below that level but closed back above it. That created what traders call a swing failure pattern, which often signals potential bullish reversal structure. On lower time frames, an inverse head and shoulders formation appears to be developing, although we haven't yet seen displacement. The strong, high-volume move confirming buyers have taken control. The February 6th candle now acts as critical support. Currently, the 72.6 to 70 zone is where price recently bounced. Price may revisit that area again, but if buyers are serious, we shouldn't see strong closes below that range. To be clear, support isn't a guarantee by signal. It's a framework. If price holds and displacement occurs, moves towards 75 or even 77 become possible. But if price closes decisively below that support, weakness could extend towards 67 or lower. And now we connect technical structure to what options markets are signaling. Silver volatility at 115 means traders expect aggressive movement within the next month. Volatility doesn't predict direction, it predicts turbulence. With March contract notice periods approaching and positions still needing to roll or deliver, exchange-level stress can emerge quickly. At the same time, large investors continue accumulating long-dated gold call spreads despite falling prices. Some of these positions would only pay off if gold prices multiply significantly by late 2026. Yet accumulation continued even after recent declines, suggesting someone with serious capital expects a violent upside move eventually. And when discussing current market structure, it's impossible to ignore documented manipulation history. Major institutions have paid enormous fines and seen traders convicted for spoofing and manipulating precious metals markets. These are court-documented events, not conspiracy theories. Understanding this history helps explain why price action sometimes disconnects from physical market realities, especially during periods when Asian markets close and Western paper markets dominate trading hours. What we're seeing now could simply be another phase where liquidity pressure creates price distortions before fundamentals reassert themselves once forced sellers are exhausted. Physical holders often understand this dynamic. They're less concerned with short-term volatility and more focused on long-term supply deficits and demand trends that paper selling can't permanently suppress. And sentiment? Right now, emotion screams that the silver rally is over. But markets rarely move politely. Strong trends shake out weak holders along the way. Extreme pessimism often builds the foundation for future advances when only conviction holders remain. Commodities analysts continue projecting higher long-term silver prices driven by industrial demand from solar, AI infrastructure, and electronics, combined with potential monetary demand as countries diversify reserves. Meanwhile, supply deficits persist, and global wealth allocation to silver remains historically tiny compared to previous bull markets. So the critical question becomes, is this the end, or simply the painful middle phase where leverage unwinds before the next structural move begins? To understand where things might go next, we also have to seriously examine the bearish side instead of only repeating bullish talking points. Liquidity crises don't respect long-term fundamentals in the short run. When forced selling begins, paper markets can temporarily overwhelm physical supply dynamics. A strong dollar and rising volatility can mechanically push prices lower even when underlying shortages still exist. There's also the possibility that recent stress signals fade quickly. The repo window usage might prove temporary rather than systemic. Upcoming economic data and central bank messaging could spark another wave of selling if markets interpret policy as restrictive for longer. And technically, if silver fails to hold the support zone around 72.6 to 70, the next levels down could open quickly, possibly revisiting the mid-60s or even lower before stability returns. Volatility spikes don't guarantee explosive upside. Sometimes they simply resolve through extended choppy movement that exhausts both buyers and sellers. Traders expecting immediate fireworks can get chopped apart in that kind of environment. That's why context matters more than predictions. So let's step back and assemble the full picture rather than focusing on isolated data points. We have volatility pricing extreme movement over the next month. We have banks quietly accessing liquidity facilities again. We have currency strength, rising market fear indicators, and falling yields, a combination that historically appears before broader market stress. Equity markets just showed violent intraday swings typical of forced liquidation rather than orderly selling. Meanwhile, options positioning suggests some large players are quietly positioning for a powerful future move higher in precious metals, even while prices weaken today. Eastern physical markets continue trading at premiums over Western paper prices. Technical charts show potential reversal structures, but still require confirmation. Sentiment has flipped from euphoria to fear extremely fast, often a necessary reset during longer bull cycles. And all of this is happening while global allocation to silver remains tiny compared to past cycles, meaning even small capital flows back into the sector could move prices dramatically once deleveraging pressure subsides. At the same time, short-term risks remain real. Liquidity stress can push markets further than logic suggests. Support levels can fail. Volatility events can take longer to resolve than most traders expect. This is why understanding market mechanics matters more than chasing narratives. Because what deleveraging creates are artificial price dislocations. Prices move away from fundamentals not because fundamentals changed, but because participants are forced to sell. When forced sellers run out of inventory, markets often snap back violently as equilibrium returns. The real question isn't whether volatility is coming. The options market has already answered that. The question is whether you understand what kind of volatility this is and how these phases historically resolve. Those who panic at lows usually sell assets that eventually recover. Those who chase hype at highs often buy right before corrections begin. The advantage belongs to those who stay calm, analyze data, and understand where markets sit within larger cycles. If the current episode truly is a liquidity-driven unwind, then once pressure passes, attention will return to structural issues, supply constraints, industrial demand growth, currency dynamics, and long-term capital allocation trends. That's when fundamentals matter again. But until then, turbulence is part of the process. So step back from the noise. Separate emotion from information. Watch liquidity signals, volatility metrics, and price structure instead of headlines. Markets reward preparation, not reaction. Because in the end, investing isn't about hype, panic, or predictions. It's about logic, discipline, and understanding how capital actually moves when stress hits the system. Volatility is here. The next phase depends on who runs out of liquidity first, forced sellers or patient buyers. Study the data. Make decisions based on evidence, not excitement. Con AG out.